The bear case for Brookfield Infrastructure is not necessarily a critique of its asset quality, but rather a warning about the risks inherent in its financial architecture and the potential for a liquidity squeeze in a high-rate environment. A primary concern for skeptical analysts is the looming maturity wall of global debt. Projections indicate that approximately $33 trillion in debt across advanced economies will mature in 2026. This massive refinancing requirement is expected to strain global liquidity and potentially drive borrowing costs higher, even if central banks begin a cutting cycle. For a partnership with $59.6 billion in non-recourse borrowings, the cost of rolling over debt becomes a significant variable. While Brookfield management emphasizes that 90% of its debt is fixed rate with an average term of 14 years, the absolute level of interest expense is rising. In 2025, interest expense reached $3.87 billion, up from $3.39 billion in 2024. Bears argue that if interest rates remain higher for longer, the spread between the partnership's return on invested capital and its weighted average cost of debt will narrow, placing pressure on the funds available for distributions.
Another point of contention for bears is the sustainability of the partnership's distribution when analyzed through different lenses. Management consistently reports a payout ratio of 60–70% of FFO, which appeared stable at 67% in late 2025. However, some financial platforms report a dividend payout ratio exceeding 250% when calculated against GAAP net income. This discrepancy arises because net income is heavily suppressed by non-cash depreciation and amortization charges, $1.1 billion in 2025, associated with long-life infrastructure assets. Bears contend that a more prudent metric is adjusted funds from operations, which deducts maintenance capital expenditures. Historically, the AFFO payout ratio has been significantly higher, reaching 86% over the 2013-2024 period. While maintenance capex is relatively low for these assets, any unforeseen increase in the capital required to maintain the existing portfolio could quickly tighten the distribution coverage. Furthermore, the interest coverage ratio on the U.S. Leveraged Loan Index, a proxy for the broader high-yield market where infrastructure often sits, narrowed to 4.6 times in 2025 from 6 times in 2022, suggesting that highly leveraged entities are operating with a smaller margin of safety. Legal and economic risks of contractual protections. The partnership's reliance on take-or-pay and long-term contracts is often cited as a strength, but bears point to the legal and economic vulnerabilities of these agreements during severe downturns. In the natural gas industry, for instance, a decline in demand can leave pipeline companies in the position of paying for gas they cannot market.
Furthermore, legal precedents suggest that during periods of extreme commercial impracticability, courts may provide relief to buyers, potentially undermining the guaranteed nature of these cash flows. While Brookfield's contracts are often with investment-grade counterparties, a systemic economic shock could lead to force majeure claims or liability management exercises that disrupt the expected revenue stream. In the transport segment, while toll road volumes were resilient in 2025, they remain sensitive to GDP growth. A global rolling recession could lead to traffic declines that are not fully mitigated by inflation escalators. The bull case, operational alpha, and the AI supercycle. The bullish outlook for Brookfield Infrastructure is rooted in the partnership's acquire, enhance, recycle strategy, which has historically produced a 14% FFO KGR and a 9% distribution KGR since 2009. This model is predicated on identifying undermanaged or capital-starved assets, applying Brookfield's operational expertise to improve cash flow, and eventually divesting them at mature multiples to fund the next generation of growth. The most compelling pillar of the current bull case is the partnership's pivot toward digital infrastructure, a sector that management believes is in the early stages of a massive investment cycle driven by the proliferation of generative artificial intelligence and the consequent demand for data processing and storage. The data segment's performance in 2025 was a harbinger of this potential, with FFO reaching $502 million, a 50% year-over-year increase. This growth was catalyzed by the integration of the U.S. bulk fiber network and the commissioning of substantial new capacity across the hyperscale data center platform.
Brookfield's digital footprint now encompasses 300,000 telecom towers, 2 semiconductor foundries, and over 150 data centers, with approximately 2.3 gigawatts of contracted capacity. The strategic focus is not merely on owning the real estate of the digital world, but on providing the critical power and connectivity solutions that AI requires.
For instance, the partnership has executed agreements for behind-the-meter (BTM) power projects totaling 230 megawatts of capacity, part of a broader framework to install up to 1 gigawatt of power solutions specifically for AI factories. This vertical integration, owning both the data center and the power generation solution, allows the partnership to capture a larger share of the value chain and offers a competitive moat against pure-play data center REITs. The $30 billion semiconductor co-investment program with Intel Corporation serves as an example of the partnership's smart capital approach. By funding 49% of the Ocotillo campus expansion in Arizona, Brookfield Infrastructure secures a long-term interest in the most advanced chip manufacturing capacity in the United States. This investment is designed to be accretive to earnings during the ramp phase and provides a $15 billion cumulative benefit to Intel's adjusted free cash flow, illustrating Brookfield's role as a vital provider of scaled capital for the tech industry. While the AI story provides the growth narrative, the partnership's legacy assets in utilities and transport provide the stability that supports the distribution. A critical insight for investors is the mechanism of inflation indexation embedded in the portfolio. Approximately 85% of FFO is derived from assets that are either regulated or governed by long-term contracts, and 75% of total FFO has direct or indirect escalators indexed to inflation.
In the utilities segment, which generated $786 million in FFO in 2025, revenues are primarily derived from government-regulated rates for electricity transmission and residential connections. This segment acts as a real asset hedge. As global inflation persists, the rate base and subsequent cash flows adjust upward, protecting the purchasing power of unit holder distributions. In 2025, this inflation indexation, combined with the commissioning of $500 million of capital into the rate base, drove a 7% increase in segmental FFO. A central tenet of the bull case is the partnership's ability to self-fund its growth, reducing its reliance on dilutive equity raises or high-cost debt markets. The 2025 fiscal year demonstrated this capability with record clarity as the partnership exceeded its $3 billion capital recycling objective. By monetizing mature assets, such as partial stakes in container portfolios and Brazilian electricity transmission concessions, at IRRs exceeding 20% and capital multiples as high as 8.5x, the firm creates a perpetual pool of liquidity for redeployment. This capital recycling engine is expected to maintain its momentum in 2026, with a further $3 billion in asset sales already targeted. The conviction in this target is supported by two secured transactions, including the sale of the largest of 4 Brazilian electricity transmission concessions, which alone is expected to generate $150 million in net proceeds to the partnership. This strategy allows for a disciplined return to 10% per unit FFO growth in 2026 and beyond, as the proceeds are reinvested into higher-yielding AI and digital infrastructure projects.
Company Overview. Brookfield Infrastructure Corporation was established in 2020 to provide an economically equivalent share that issues standard tax forms. This strategic move was transformative, significantly broadening the investor base by allowing BIPC shares to be held more easily in tax-advantaged accounts like IRAs and 401ks, and facilitating their inclusion in major equity indices. The market's reception of this duality is evidenced by the trading premiums often observed in BIPC shares relative to BIP units. Institutional ownership of BIPC exceeded 70% by late 2025, reflecting its role as the preferred vehicle for large-scale funds seeking stable infrastructure exposure without the administrative burden of partnership accounting. Despite these structural differences, both tickers track the same distribution policy, which recently saw its 17th consecutive annual increase, a 6% lift to $0.455 per unit quarterly, or $1.82 on an annualized basis. Deep Dive: The Mechanics of Growth in Core Segments. Utilities: The Stabilizing Force. The utilities segment serves as the bedrock of the partnership's cash flow. In 2025, the segment's FFO of $786 million was supported by approximately $500 million of capital commissioned into the rate base over the preceding 12 months.
One of the more nuanced growth drivers in this segment is the residential decarbonization infrastructure platform, which services 10.4 million customers globally. This platform is not just a provider of water and heating. It has begun implementing operational AI to optimize customer interactions. For example, the use of AI in call centers for complex billing queries has already created approximately $10 million in annual value.
This demonstrates how Brookfield can derive operational alpha from traditional assets by applying modern technology to legacy business models. Transport, volume resilience, and the Triton integration. The transport segment, which generated $1.1 billion in FFO in 2025, is primarily driven by the movement of freight and commodities. The segment's performance was bolstered by a 3% increase in toll road volumes and a 2% increase in rail rates. A significant milestone was the successful integration of Triton, the world's largest intermodal logistics operation, which was privatized in late 2023. Brookfield invested $1.2 billion for a 28% interest, and the business has consistently performed ahead of expectations, generating a base case IRR above the partnership's targets. The integration of Triton allows the partnership to benefit from the de-globalization trend, as global supply chains become more fragmented and require more sophisticated container management and logistics solutions.
The midstream segment, contributing $668 million in FFO, saw a 7% year-over-year increase in 2025. The primary catalyst was the record 94% utilization rate achieved at the recently acquired U.S. refined products pipeline system. By moving to single ownership for the first time in the asset's history, Brookfield has been able to advance strategic initiatives to optimize flow and pricing, generating meaningful value that was previously lost in a fragmented ownership structure. Furthermore, the Canadian natural gas operations commissioned several bolt-on projects in 2025, including a pipeline project that is expected to contribute CAD $15 million in run-rate EBITDA. These projects are particularly attractive because they are developed at a weighted average build multiple of 4x, compared to the 8 to 10x multiples typically paid for acquisitions in the open market. This build-to-core strategy is a key component of the bull case for the midstream segment. The data segment is the partnership's fastest-growing unit, with a contracted project backlog of 1.1 gigawatts and a land bank of 1.3 gigawatts ready for development. The pivot toward AI infrastructure is not just a marketing narrative, it is reflected in the tangible deployment of capital. In 2025 alone, the partnership commissioned 220 megawatts of capacity at its hyperscale data centers and 200 megawatts of new billings at its U.S. retail co-location operations.
The synergy between the data segment and the rest of the portfolio is critical, as AI data centers require massive amounts of reliable 24/7 power. Brookfield Infrastructure can leverage its expertise in energy transmission and natural gas midstream to provide integrated solutions that pure-play data center developers cannot. This ecosystem approach is designed to capture a higher percentage of the estimated trillions of dollars required for the global AI build-out. Financial governance, the role of the sponsor, and IDRs. An analysis of BIP must account for its relationship with Brookfield Asset Management, BAM, which acts as the general partner. BAM's 30% ownership and its holding of incentive distribution rights, IDRs, create a unique incentive structure. While some market participants view IDRs as a drag on unit holder returns, Brookfield's IDRs are significantly lower than the 50% high splits common in midstream MLPs. This lower cost of capital allows the partnership to be more competitive in large-scale bidding processes. Moreover, the 1.25% base management fee provides BAM with a stable revenue stream, incentivizing the long-term stewardship and expansion of the infrastructure portfolio rather than short-term fee extraction.
Mathematical modeling of projected returns. Analysts often employ a yield plus growth model to evaluate the partnership's total return potential. Using the data from the 2025 year-end results, where distribution yield 5% based on BIP unit price of just under $37, organic FFO growth 6 to 9% target range, capital recycling alpha 1 to 2%, historically derived from selling mature assets at IRRs greater than 20%. This mathematical framework supports management's stated goal of delivering 12 to 15% total annual returns on invested capital over the long term. However, this model assumes the persistence of the 2025-2026 valuation multiples. If the market requires a higher risk premium due to the 2026 debt wall, multiple contractions could dampen these results. Conclusion. The investment case for Brookfield Infrastructure Partners at the dawn of 2026 is one of structural tension between growth prospects and an increasingly complex financial landscape. The bull case is driven by the partnership's peerless position at the intersection of the digitalization and decarbonization supercycles. Its ability to partner with tech giants like Intel, its vertical integration of power and data infrastructure, and its disciplined build-to-core strategy in midstream and utilities provide a clear path to double-digit FFO growth. The 17-year track record of distribution increases serves as powerful evidence of the management's ability to navigate previous cycles of interest rate volatility and economic uncertainty. The bear case is anchored in the reality of the partnership's $59.6 billion debt load in an era where the cost of capital has reset at a higher level. The narrowing of interest coverage ratios and the potential liquidity squeeze of the 2026 maturity wall represent systemic risks that could force the partnership to slow its growth or face margin compression. Furthermore, the premium valuation of the BIPC shares suggests that the AI tailwind may be over-extrapolated by current market participants.